Hello, Via community. It is Helmer coming to you this week, as always, with your mortgage market update. And this week of September 13th, 2023, I am joined with our return guest, Jerry Avila. Jerry, thank you so much for joining us again. How you doing, man?
Doing great. Just kind of keep plugging in and trying to help out more people. Answering questions.
So just remind everybody what you do for a living, that you don't, you're not a grocery cart guy, or what do you do again?
Yeah, so I'm a mortgage loan officer here within the group, and what I do is help people purchase homes by finding the best possible opportunity for them to purchase a home with the proper financing.
Awesome. Your audio is a little very echoey. You might want to make sure you're on your right microphone or come closer to your microphone.
Yeah, that might fix the problem right there.
Because it's a little quiet for me. But all right. So as you know, those of you that are joining us, thank you so much. Remember, if you guys have any questions or comments, we want to hear those. So feel free to say hello. If you're here live, say good morning or good afternoon, whatever it is in your neck of the woods. Many of you do watch on the replay. And if you do watch on the replay, do us a favor. Just put hashtag replay in the comments. Let us know that you were here. And with that said, let's kind of jump right into what we said last week, and we'll do a quick rate recap. So moving forward, let's see, let me pop this up on the screen and we'll bounce through a couple of slides. All right. So remember, whenever we talk about rates, this is not an offer to lend. Hold on. Why is that not showing up there? There we go. Well, there it is. When we talk about rates, remember, this is not an offer to lend. We're talking about averages and generalities. You, of course, do want to shop around. But if you are out there and you're getting some quotes and you want to know, Helmer, is this sounds like it's legit? Here's what we have seen. So since last week, rates have been stable. And when I say that, what I mean is we haven't seen necessarily a lot of movement to rates. They tend to go up or down a little bit each day, and sometimes rates will remain the same, but that credit that you get towards your closing costs, or what we like to call the rebate, or maybe what it costs you to get a better rate, sometimes we call that points, or if you're buying a buy down, those will go up or down a little bit each day. But overall, after seeing rates move up significantly, then they kind of dropped a little bit, then they moved up again last week. This week, we're kind of in the same boat. And they've been very much the same. VA rates are averaging the high sixes to low sevens. Conventional rates are averaging in the low to mid sevens. They can get a little bit higher than that depending on credit score and the amount of money down. But overall, generally, if you're getting a quote in a VA rate that's somewhere, in the mid sixes is a really, really, really good rate. I would look closely at that one. The middle, the higher sixes, that's going to be very much par for the course. And if you're in the low sevens, you may want to make sure that there's a reason for that. So, Jerry, what do you think? Does that sound about right to you?
Yeah, absolutely. Right now, the market's kind of just been up and down a lot. So right now, when you're looking at rates, it just kind of depends on the circumstances and where they're at and where they're purchasing. But when I'm looking at rates right now, yeah, they are probably about, I would say about 6.75 ish to about 7.25 ish, depending on where their credit is. Pretty much, some investors are tacking on a little bit extra for lower FICO scores, so it just kind of depends. I'm seeing a lot of manuals, so that's kind of why I'm saying there's a lot of rates in that space.
Right. And for those of you that don't know, when Jerry says manual, he's talking about manual underwriting scenarios. Most underwriting is done via AI. AI, very popular term. We have had an automated underwriting engine since 1997 in the mortgage business. So it's been well over 20 years that we've had an automated underwriting engine, 25 years even. And but yet now, if we say we have AI in the mortgage business, it sounds very impressive, but sometimes those computers just need a little bit of help, and we do have manual underwriting. That's especially important if you're a veteran, because VA mortgages, I would say, in my opinion, give more leeway and more of an opportunity for an underwriter to look for a reason why it makes sense to do the loan for the veteran. Whereas conventional financing, there's a lot less of a ease to getting a manual underwriting scenario. What do you think, Jerry? Does that sound right to you too?
Yeah, I mean, unfortunately, just like every scenario is different. So when you have automated underwriting, you're going to get a little bit of an easy process, but when you have to get into the weeds of things and look at someone's credit, like all that's going to have to come into play when you don't get an automated approval, right? So you want to be digging in even before you run that automated approval, because you can sometimes tell, is this going to be a manual underwrite potentially, because we're seeing X, Y, and Z kind of on the credit report that's kind of making it a little bit concerning.
Yep, and that's why you want to make sure that you are dealing with a vetted professional that can help you in those scenarios and be your champion, in this scenario as well. So, all right, well, let's go ahead and give you all a quick forecast on where we think things are going to go from here and why, and also talk about what else that we are working with these days. So this week was all about inflation, and that actually started today. We got our first inflation report. It's the CPI inflation, which stands for Consumer Price Index. It is a consumer inflation report. And if we take a look at that and look at the headlines, basically the data came in very much where it was expected to come in. And inflation's still a thing. We absolutely do still see inflation, but inflation has come down quite a bit from June of last year, where it peaked at about 9.1%. And this time around, the numbers, what they call the headline number, the main number, the month over month, meaning, what things have gone up from the previous month, was 0.6%. Annually, year over year, it's 3.7%. And then we also like to break it down a little bit further, and we look at what we call the core CPI, and that pulls out energy and food prices. Food prices and energy prices can be very volatile. For example, the price of gas at the pump can move up and down quite a bit based on some different factors. So when we take those out, it was the CPI, the core CPI was 4.3 with an estimate of 4.3, a little bit higher month over month, though, with a 0.3 versus 0.2. So what does all of that mean in the world of mortgage rates? Well, it means basically, because traders had already expected this, things are very much the same. Mortgage rates very much unfazed by this news. This morning, we saw a little bit of movement behind the scenes, but generally rates today very similar to what you would have seen yesterday, and that's actually a good thing. This data had the potential to come out and cause mortgage rates to move higher. It was very unlikely we would have seen a scenario where it would have helped rates to move lower, and by coming in very much where it was expected, basically how that comes into play is how it affects the market's view of what the Fed is going to do, what the actions the Fed is going to take. And actually, if we jump over a little bit, that's what we're waiting on next. Everything is, what are the expectations that the Fed is either going to raise its policy rate either in November or in September. And if I show you guys a chart, this is called a Fed futures chart. So what we're doing is looking at the probability of a future Fed rate hike and what the markets are betting on. And there's a 97% expectation that the Fed is going to leave their Fed policy rate unchanged at the meeting next week. And that's a big deal, but there is an expectation that they're going to raise it the following meeting in November. Now, mortgage rates, as we've talked about in the past, they react ahead of time to speculation of what's going to happen on these different scenarios rather than what actually happens when it happens. So if we see a belief by markets that the Fed is more probable, more likely to raise rates at this November meeting, that's going to pressure mortgage rates a little bit, and we'll see them get a little bit worse. If we were to see any kind of speaking from the Fed next week and it made markets believe that maybe the Fed is done raising rates altogether and there will not be one more Fed rate hike, then that would actually help mortgage rates a little bit. So we do have a little bit of a unique situation when we're forecasting. Rates are likely to be stable between now and next week's Fed meeting. We're not likely to see too much movement ahead of time. There's not a lot of data. Tomorrow we get the wholesale inflation. So we've had consumer inflation, what happens on the consumer side, but we also monitor inflation on the wholesale side. And that's, has a much less of an effect on mortgage rates, but we can see a little bit of movement tomorrow. But overall, it's really just about that same expectation of where the Fed's going to be for the next 15 days. Very likely that rates are going to remain relatively the same. over the longer, maybe the next couple of months, rates could move higher depending on what happens at that Fed meeting next week. And we'll be talking about that. We actually meet you guys at 12 p.m. Eastern, and the meeting concludes and the press conference starts at 2 p.m. and 2:30 p.m. Eastern time, respectively. So we'll talk more about that next week. But as of right now, the main thing to focus on is that rates are very likely to be pretty stable between now and next week's Fed meeting. Jerry, do you agree with that, or is there anything you would add or
No,
talk about on that?
absolutely. No, I absolutely agree. I think that at the end right now, what we're looking at is hoping for that stability, that kind of hold pattern, just because we know that that'll have an improvement on rates. And so we want to definitely see some of that happen here in the very near future. So that way we can, kind of see some easing of the rates a little bit, just a smidge.
Yeah. And then a lot of people, we didn't expect to see mortgage rates in the 7s. We thought mortgage rates would be in the 4s or maybe the 5s. And here we are in the 7s. Jerry, do you think mortgage rates are going to move out of this range anytime soon?
It just really depends on how some of these meetings go, in my opinion. A lot of it comes down to how the Fed chair decides to put out the information, what his gut feelings are, and so ultimately that's going to dictate that. But I mean, I'm hoping and looking at things in a very positive outlook. I'm hoping that and seeing that rates should improve here over the course of the next few months. How soon, I don't know. I mean, hopefully with some of this news that we got today, that'll start helping and, staving off on some of those rate hikes, and hopefully actually even just stop them altogether. Because if it does, and then the market should see some improvement rather quickly.
With rates in the 7s, do you think it's still a good time to buy a house?
Always, because at the end of the day, it's not what your rate you're getting in on, it's what you're ultimately keeping, which is that property, right? At the end of the day, you'll be able to do a refinance later down the road, whether it be a VA IRRRL, which is just an interest rate reduction refinance loan, or just doing a cash out later on down the road and lowering your rate anyway. So it's just the options are out there to actually see some benefit, even though rates are high at the moment.
Yeah. And remember, everybody, the reality is that home prices are not falling, even with rates where they're at. And when rates do go down, if and when they go down, home prices, that actually is going to encourage home prices to stay or move higher. So it's very unlikely that you're going to get in a bad spot right now. Of course, anything can happen. What we would look out for if we see a crash in the labor market, if unemployment rises, dramatically, if we see the economy really take a bit of a bath. One thing I'm concerned about is the amount of consumer credit that's out there. I believe a lot of the spending and consumer spending that's driven the economy has been borrowed. And, as long as we don't come due on that too quickly, in other words, as long as people can, pay those payments, keep things going, we'll be all right. But if we start to see people fall behind, that could cause more of a snowball effect and could hurt the economy. So, but those are all things that are more likely to happen as we head into 2024 than anything on the near term. So, awesome. Well, Jerry, is there anything else that you would kind of wrap up with or end with? We keep these short now, just really kind of give everybody a quick update.
No, for sure. Yeah, I mean, the only thing is it just like you were mentioning earlier about rates, it's like, don't worry about where we're at right now. I mean, at the end of the day, as long as you get your foot in the door and get yourself into a home, that's the number one goal. Once you're there, then we can work on the rates as rates improve. Know that it's a long-term play. It's not a short-term play. Because ultimately, if you need housing, you're going to need to pay for it anyway. Might as well have it be into something that's yours.
Absolutely. Couldn't have said it better myself. So, well, thanks, Jerry, for joining us. I appreciate it. Even if you do have that nasty stuff on your hat, it's okay. We still love you, even if you're a Dallas fan. And, you know what the Dallas fans always say, this is our year. We all laugh at
You
that.
never know. It might be.
We
might get lucky and actually hit it this time.
I pick on Dallas, but I have a lot of respect for the organization and the team. And I think back to the 90s teams, with Emmett and Aikman, and those were great teams. So anyway, y'all, you guys, we will see you next week. Again, we'll talk more about what's going on with the Fed, where mortgage rates are headed. So be sure to join us next week. Same bat time, same bat channel, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. If you're in Hawaii, you got to figure out the math on that one yourself. So, all right, everybody, I'll see you next week.